Hello again, students. I want us to go through our lesson 2. Having introduced lesson 1, I want to believe that now you are able to understand a few basics about economics, and therefore when we go to demand and supply, you'll be building on what we have already learned. Again, my name is Dr. Felis Tanjero. I believe you are staying safe at home, and thank you for watching. Now let's go to demand and supply, our lesson 2. The issues of demand and supply, it enables us to understand the determination of prices and the quantities that are brought into the markets or in different markets, and the factors that influences the supplier and the consumer. We want to look at basically what is the behavior of the consumer. We ask ourselves, who is a consumer, who is a supplier? Maybe for today I can be able to tell you that the consumer is that individual who utilizes that final product, the product that is already a complete product. That is the consumer. The supplier is one who engages in provision or bringing into the market and selling goods and services to the consumer. That is the supplier. The supplier could be the person who is also producing and bringing to the market, or could be a merchant who buys and supplies. So all those could be categorized as a supplier. Our concern in this lesson is trying to understand what influences the decisions that are made by that consumer, and what decisions, factors that influences the decisions that are made by the supplier. That will be our concern. So at the end of this lesson, we should be able to outline those key determinants of demand and supply, explain the differences between a movement along the demand curve and the supply curve, explain the concept of the market equilibrium, and market equilibrium means the market is stable, distinguish between the maximum and minimum price controls, and explain the consequences of each of those, and compute equilibrium values in elementary market models. So we start by understanding what is demand. Demand refers to the quantity of a product that the consumers are willing and able to buy at a given price over a given time period. What is the key issue here in this definition? The key issue is the willingness of the consumer. The other key issue is the price. The other key issue is the time. Meaning, it is possible for a consumer not to be willing to buy a certain product at a particular time. Similarly, the price is another key element here, because given the price of a product X, I as a consumer may be willing to buy it at one point, and at another point with the same price I may not be willing to buy the same product. So there is what we call the 3 key issues: the price, the willingness, and the issue of the time period in definition of demand. It is important to realize that demand is not the same thing as want or need. For us to have what we call effective demand, we must have those 3 things. There is the ability, the willingness, and the willingness to pay the price. And that is what we call effective demand. We move on. We ask ourselves, what is it that controls demand? We have said that the consumer must be willing, must be able, and must be able to afford that particular product at a specific time period. Normally, consumers have got a common behavior. And we are not saying that this is 100%, but we are saying there is that common behavior that is observed, that when we hold all other factors constant, the demand will always decrease as long as the price of that product is increasing. That is a normal behavior of the consumers. But we are saying it is possible they may behave differently, and that is why we are saying holding all other factors constant, because there are other chances or situations where the consumer will behave not as we expect, will buy products, more products, when their prices are increasing. We are going to look at that later. But for now, we take the normal law of demand, where we say that demand and price, they have what we call an inverse relationship. When we look at this table, where we can call it a demand schedule, just to demonstrate this law of demand. The price has increased from 20 to 40 to 60 to 80 to 100. And as long as there is that consistent increase of price, we look at what is happening to demand. The demand, when the price is at 20, the quantity demanded is 100 units. Let's assume we are talking about the 20 shillings. The units that are demanded of a certain product is 100. This is a hypothetical demonstration. When the price increases to 40, the demand decreases to 80. Similarly, 60, the price increases to 60. Quantity demanded decreases to 60. The price increases to 80, and demand decreases to 40. The price goes to 100, and the quantity demanded goes down to 20 units. That means the price increasing, the demand decreasing. We can demonstrate that using what we call the demand curve. On this axis here, we have the price and the quantity demanded. And we have demonstrated, and we can see that the curve demonstrates a flow from left downwards to the right. It shows that inverse relationship between the two variables. Now we said holding all factors constant, meaning it is not 100% that when the price increases, the demand will always go down. There are exceptions to that rule. So we ask ourselves, what are these exemptions to the law? Now, one of the exemptions, we are saying a situation where the price increases and the demand also increases. The first exemption is where the goods are called given goods. G-I-F-F-E-N, given goods. What are these goods? I want to explain about that situation. What will make the consumers consume more of a product when its price is going up? The given goods have got a number of features. One of the features is the fact that, number one, they are considered to be inferior. We call them inferior, but I put in quotes. When we look at a product as an inferior, we associate it with a product that attracts low-income group of the society. Now, what happens when the price goes up? Normally, I want to explain this, and I hope you follow my argument here. Let's give an example of what we call the sukuma wiki, or the kales, the vegetables. To all of us, they look inferior, such that every day this inferior product is what is available or affordable to the low-income group. Now, this low-income group, in case they are able to, for example, in 1 week, they are consuming the low-income product, the inferior product, the sukuma wiki. And for like 5 days in a week, they consume that. On maybe 2 other days in the week, they may afford what they prefer to be superior, or what they look at in their minds to be superior. So what happens? If the price of the sukuma wiki goes up, they no longer can afford what they think is superior, maybe meat or fruits. So, because they no longer cannot afford the superior product, they consume more of the inferior product. So, when the price of those goods go up, they will consume more. And that is an exception of the law of demand. That is one case. Then, the other situation that would cause maybe the consumer behave not the way we expect or against the law of demand, it is where the product is what we call goods of ostentation, or Veblen goods. Goods that are bought for show off. we all know that there are people who will go to very high, great extent to buy goods to impress other people. If those goods are expensive and not everybody can afford them, that is what excites them. And so when the price increases, they will buy more of those goods because it will give them the satisfaction they're looking for. Supposing the price goes down and everybody now can afford. You know, when everybody can afford, they no longer do not give the satisfaction that it was giving. And therefore, when the price goes down, the demand goes down. When the price goes up, so that it can kick out all other people, then that is what gives them the satisfaction. So they buy more of those goods. Goods that are of ostentation or valuable goods. They are also called goods that are bought for snobbish appeal, for show off. That is why we find, I want to give an example of when the young men will buy maybe a Toyota Celica, for example, and will go on to pimp it and just to show off. But if it stops giving them that appeal, then they will not buy it. They will not spend that money. That is the second reason why the law of demand will not be obeyed. Then what about the third reason is when the product is a habit-forming product. For example, alcohol, cigarettes. Even when their price goes up, people will still continue to consume more. Why? Because they are addicted to it. And because of that, this will also not obey the law of demand. And as such, you realize that the demand curve will be the opposite. I want us to go back and see and compare that demand curve, the demand curve here. This demand curve here, the demand curve, in normal circumstances, it will flow from left downwards to the right. But when this law is not obeyed, the demand curve flows upwards from the left to the right. It flows upwards. And that is the difference when the law of demand is not obeyed. What determines demand? The quantity of goods that are bought at a given price at a given time period. Now, one of the things, there are a number of reasons or determinants or factors that influences demand. The first one is the price of the product. Price is the key item because it is where even the law of demand is based on, that when the price goes up, demand goes down. The price of that particular product. The second one is the price of related goods. Normally, goods are related in two ways. Number one, they could be substitutes. For example, we have so many bathing soaps. We have Geisha, we have Lifebuoy, we have Dettol, we have, all those are goods that are related. And normally, it is important to know how the substitutability affects the consumer. As long as there are goods that have got substitute, if the price of one product goes up, as long as the substitute product's price remains the same or decreases, the demand for the product that whose price has gone up, the demand will go down. And the demand for the product whose price has remained stable or has gone down will go up. So it is very important to know that the price of the related products also influences demand. Products can also be complementary. Complementary goods are those goods that are used together. For example, pen and ink, car and petrol. If the price of petrol goes up, the demand for the use of car will go down. Why? Because the consumer will react negatively towards the increase in price of petrol because the goods are used together. They are complementary goods. The other factor is the consumer's income. In normal circumstances, when the consumer's income goes up, it increases what we call the disposable income. That disposable income allows the consumer to afford more, so the demand will go up, and vice versa is also true. What about the consumer tastes, preference, or fashion? If, for example, the consumer has got a favorable taste or favorable preference on a certain product. Also, if the product is on fashion, people are likely to have a higher demand irrespective of their prices. Now, and the opposite is also true. The other factor is future expectation in price changes. If the consumer expects that in future the government, maybe through taxation or just before the budget time, the budget is read, we normally speculate and say the price of sugar is likely to go up or down. At that time, if the consumer expects the price of the product to go up in future, they will consume more today and vice versa. They will postpone the consumption or demand if they expect that the price is likely to decrease in the future. Advertising is one way that kind of influences demand. It creates demand and for a certain product. So that is also another factor. Also, the government policy. Normally, through taxation, through subsidies, through what we call the quotas or bans, the government is able to influence demand. For example, if the government wishes that the demand of a certain product decreases, it increases the tax. And the opposite is also true. If the government wishes that the consumer's demand increase on a certain product, it is likely to subsidize. And we see that even in our country today. The government would always wish that people will go to school, and therefore they give what we call free education. They subsidize the education system. Why? It wants the demand for that particular product to increase. And when the government wishes, for example, to reduce the consumption of alcohol, what does it do every other time? It increases the tax on that particular product. The government can also impose quotas. A quota is where the government says in this financial year, only this number of a product will be imported, maybe cars will be imported into the country. That is a quota. Or it may say that there is no production, there is zero production of a certain product X, maybe the illicit brew. That is what we call a total ban. So through government policy, the demand can also be increased or decreased. What about the season or time? Some of the products are only demanded at specific time. For example, umbrellas. When it is not raining, surely, nobody will have its demand. And therefore, some of the products, the season or time will affect demand on our specific products. I want to explain a few things about the movement along and a shift of the demand curve. Normally, we've looked at the factors that influence demand. We have talked about the price of related products. Now, the price alone, the price only as a factor, influences what we'll call a movement along the demand curve. A movement means there is a change in demand due to price. Now, demand is a multivariate function, in the sense that it is influenced by a number of factors like we have seen. However, the movement along the demand curve is demonstrated by the change in price and price only. All other factors will cause what we call a shift of the entire demand curve. Let's look at the following curves. The movement, when the price changes from price 1 to price 2, at price 1, the quantity demanded is at this point here. But when the price changes from P1 to P2, the demand changes from Q2 to Q1 because it is a decrease, and vice versa. If the price had decreased from P2 to P1, the demand would have increased from Q1 to Q2. Note, the movement is along the same demand curve, D1, D1. And that movement has been caused by only one factor, the price. However, when the other factors change, I want to take you back to the factors that we talked about. The price of the related products, the consumer's income, the taste, the future expectation, advertising, government policy, etc. All those others, the change in any of those will cause the shift of the entire demand curve from D1 to D2, as demonstrated on our curves here. Let's look at what is likely to happen. Supposing the change of those other factors are favorable, the demand curve will move from D1 to D2, which means that at whatever price, more is demanded. If, for example, the product is on fashion, if there is government favorable policy on that product, that is favorable condition. More will be demanded at price 2, more will be demanded. At price 1, more will be demanded, because the demand curve will have moved entirely from D1 to D2. If those factors, on the other hand, are unfavorable, the key word here is unfavorable or favorable. If they are unfavorable, the demand will move from D2 to D1, meaning at whichever price less is demanded. That is referred to as the shift of the demand curve. So I want to remind you what I've said here, that there are two things that we are talking about: a movement along the same demand curve and a shift of the entire demand curve. A movement is caused by the change in price only. All other factors, a change in any of the other factors, will create a shift of the demand curve. I hope that is clear. So we look at types of demand. We are still trying to understand demand so that we see, we have seen what really is likely to affect the decisions that are made by the consumer. We have what we call joint demand. This is where two commodities, X and Y, or A and B, are always demanded together. For example, we talked about complementary goods. As long as you want to use your car, you must have a demand for petrol. You know, those are goods that are jointly demanded. There is no way you can demand one and not fail to demand the other. If you want to use a pen, then it must have some ink. So all those create what we call joint demand. There is another type of demand which we call competitive or rival demand, where goods such as substitutes, they're always competing, you know. When you go to the shop, and I want you, maybe when you students, you visit a supermarket, I want you to create an observation about how consumers behave. When they visit a shelf where they have those competing products, substitute products, they take longer. Why? Because even in their minds, there is competition. These goods compete in the minds of the consumer. And that is why you find that producers will put them in very beautiful colors, different colors or shapes. They are branded. It is supposed to attract the consumer. And what they do, they create they compete for attention of the consumer. And finally, one will pick one or the other. They are substitute goods. Tea and coffee. Every time you go to a hotel, somebody will tell you, will you want tea or coffee? And in your mind, you're trying to make a decision because they create what we call competitive demand. There is what we call derived demand. If we do not have a need or demand for clothing, we may not have demand for cotton, for example. But the reason why we demand the skins and hides is because we need shoes. One demand triggers the demand for the other product. The demand for product X triggers the demand for another product. It is called derived demand. Then we have composite demand, where goods are used in different purposes. When I buy, for example, some metal, I may use it to hammer maybe a nail. I may use it to construct. One product can be put into different uses, and this creates what we call the composite demand. Those are 4 types of demand, and we have looked at the factors that influence demand. On the other side of the coin, we talked about demand and supply. On the other side of the coin, there is no way demand will stand alone. Why? Because that demand must be satisfied. And who satisfies it? It is the supply. So we focus now, we change gear and look at the supply. We were looking at the consumer. Now we want to look at the supplier. And we ask ourselves, how do we define supply? Supply is the quantity of goods that the supplier is willing and able to bring to the market and sell at a specific price over a time period. Again, the 3 elements kicks in again. The issue of willingness, the issue of the quantity, and the issue of the price and the time period. So it is possible for a supplier to have all those goods, but he cannot afford maybe to take them to the market. Or, given the price in the market, he could not be willing to bring the product to the market and sell. That does not result to what we call effective supply. For effective supply to exist, therefore, he must be willing, he must be able to bring the products to the market and sell at a given price and given time period. Now, this can be demonstrated like we did through what we call the supply schedule, which is guided by what we call the law of supply. Just like the law of demand, the law of supply, it shows a direct positive relationship. Remember, the law of demand demonstrates an inverse relationship between the variables. The law of supply shows that the higher the price, the higher the supply. Why? The interest of the supplier is to make as much money as possible. And therefore, as long as the prices are increasing, he will be increasing the supply because they display a potential of him making more money. So price and supply has got direct positive relationship, the opposite of demand. So we can demonstrate this through the supply schedule, as I've said. The price is increasing from 20 to 40 to 60 to 80 to 100. Meanwhile, because of that increase, the quantity supplied is also increasing from 20 to 40 all the way to 100. We can demonstrate that through what we call the supply curve. In the supply curve, it moves now upwards from the left to the right. It shows the relationship. As the price increases, supply also increases. Again, like we did in the demand, let's look at what are the factors that determine supply. The first one, again, is the price of the commodity. We have said that the increase in price will increase the price. The price and the supply have got a direct relationship. So the other one is the price of the related products. Sometimes when the suppliers bring the products into the market, they consider what is the price of the substitute products, because that will affect what they sell. Then the next one is the cost of production. What will be making a supplier to be willing and able to supply and sell a certain product X? Is he able to cover his cost of production? If he cannot cover the cost of production through the selling price, then he will not be willing to do that because it will be useless for him. Another factor that influences supply is the state of technology. When technology increases, the level or the status of technology increases in a country, they are able to supply more using less resources. And therefore, that will make the supply to increase. And the opposite is also true. The next factor is the objective of the farm. Farms will always sometimes operate with targets. So, for them to be able to supply a specific area, they have put a target for themselves, and that dictates the amount of supply or the quantity of goods they bring into the market to sell. The next factor is the future expectations of price changes. Just like the consumers, the suppliers will always speculate of what is going to happen to the market prices. If they speculate that the prices are likely to go down in future for their product, they bring more to the market now that the prices are high, and the opposite is true. Another factor is the climatic conditions, the season, and the time. Sometimes the climatic conditions may not allow proper supply. Right now, an example can be given where there are floods. We were expecting a certain level of supply, but because of floods, the climatic conditions that have changed, then we are likely not to have the same supply. Season and time. Some products take time to be able to be ready for the market. During that time, we call it the dry period. That dry period, however much we want supply to be more, it is not possible. But during the harvest season for that particular product, again, the supply is plenty. The other factor is the government policy, as I explained, for demand through taxation subsidies and also the quotas and the bans. Then the government can be able to influence the quantity of goods that are likely to be supplied. Then let's move on. Well, just like I explained, the difference between the movement along the demand curve and the shift. Similarly, for the supply, we are able to look at the difference between the movement along the supply curve and the shift of the entire supply curve. Now, what causes the movement along the supply curve is the change in price. Like we can see on this curve, when the price changes, increases, the supply curve also, the quantity supplied also increases. This is demonstrated by the change from one point to another on the supply curve. Now, when all those other factors, for example, the cost of production, the status of technology, when they change, they will cause what we are calling a shift of the entire supply curve from S1 to S2 or to S3. For example, if the state of technology improves, you realize at every price more will be supplied. But if the state of technology decreases, at every price, less will be supplied. So, when the state of technology increases, the supply curve will move from S1 to S2. But if it goes down, the supply will move from S1 to S3 as demonstrated on our curves. So, those are the factors that cause the two to change. I want us to look at the concept of equilibrium in the market. Normally, when we talk about equilibrium, it means something that is equal. Here, we are talking about demand and supply. Normally, when demand is equal to supply, then we say that the market is at the state of equilibrium. It means that all that is demanded by the consumer is what is supplied by the supplier. Now, it means at that state of equilibrium, there is no shortage, neither excess supply. When we look at this equilibrium status, let's go back to our price here. The price moved from 20 to 40 to 60 to 80 and to 100. At those different price levels, the quantity demanded were 100, 80, 60, 40, 20, and quantity supplied at those different levels are 20, 40, 60, 80, and 100. 60, at price 60 shillings, 60 units were demanded and 60 units were supplied. Therefore, the market is at equilibrium at price 60. And that price here, we can demonstrate that through the demand and supply curve, as we can see on our curves here. PE is the equilibrium price. Where the two curves intersect, we call it the equilibrium point. We have the demand curve and the supply curve, and the quantities at different levels. So we can say that this market is at equilibrium when the price is at 60. At equilibrium, all the stakeholders, the suppliers and the consumers are satisfied. In fact, what is brought in the market is sold. So everybody is happy with the market situation. We call that one the equilibrium. Equilibrium in economics refers to a situation where the forces determine the behavior of the variables. That is, the variables are the price, the supply, and the demand. So that creates that all the agents to mutually consent at one point. And we say demand is equals to the demand is equals to supply. Everybody is satisfied with that market. We can derive that equilibrium mathematically, and I want to give us just one example. And we have a number of examples which you can work even at home, or you can even engage me online. So I just want to give this example. Supposing you are given two functions. We normally can derive and say the demand function is Q, the quantity demanded is equals 550 units minus 266p. Our p here is the price. And you can also be given the supply function. As such, QS, the quantity supplied, is 1526 units plus 240p. And we are saying Q is quantity and P is the price. So how you are required to determine the equilibrium market. How do you do this? We have said that at equilibrium, quantity demanded is equals to quantity supplied. So we are going to equate these two functions. Let's follow this conversation here. Quantity demanded is equals to quantity supplied. If we do that, we equate these two functions, the demand functions and the supply function, we come up with what we have demonstrated here, that 550 minus 266p is equals to 1526 plus 240p. Let us do the calculations, and we do them correctly. When we do that, we put the right terms together, and when we calculate that, our price will be, we derive P first, so that finally we use the P to establish our Q. So when we do that, we get our P being 4 shillings. Then we substitute our calculated P of 4 shillings to either of the functions. And when we do that, our Q, we are saying the market will be at equilibrium where Q is equals to 2,486. You can do that at home, and you can be able to establish that. We have been able to derive the equilibrium through the curves, through the demand and supply schedule, and also mathematically using mathematical methods. And therefore, let's go on to another thing which we are calling the price control. In our lesson 1, I talked about different kinds of economic systems. And in one of the systems, I said that the government is able to, in a planned economy, or even in a mixed economy, the government sometimes uses price controls. What is a price control? This is a deliberate action by the government to artificially impose prices on specific products. In our country, we have petrol prices being dictated sometimes by the government. And sometimes we hear, or even on TV, that from midnight to night, the price of petrol will rise from this price to the other. That is a price control. It is being imposed by the government for a specific reason. One of the reasons why the government imposes the price is maybe to dictate even the quantity of supply. Other times is to protect the consumers from being exploited. We are going to look at that later. But for now, let's look at how the prices are controlled by the government. There are two kinds of price controls that the government may impose. We've talked about the price equilibrium. And in that price equilibrium, the government may set the price above the equilibrium or below the equilibrium. When they set the price above the equilibrium, like we are going to look at shortly, we call that one the ceiling price. And we're going to look at it, but before then, let's look at the reasons why the price controls are put or are set. Number one is to ensure that the consumers, as I've already said, are not exploited. And also to motivate the suppliers. If, for example, the price are set, the equilibrium price is so low, and it is discouraging the suppliers to produce more, the government may set it above the equilibrium. And the reason being to increase the prices in such a way that it is going to motivate the suppliers to continue producing the output. Another reason is to solve on inflation. We ask ourselves, what is inflation? Inflation is a general increase of prices in the market. Sometimes this is not a very good situation, especially when the inflation goes beyond some levels, because it creates instability in the market. Now, we have two kinds of inflation. I just want to maybe demonstrate this. We have what we call the demand pull inflation. In the demand pull inflation is where too much money is chasing too few goods. When too much money is chasing too few goods, it means that there is a shortage in the market. And when there is a shortage in the market, it means the prices will generally increase. Now, to solve that, the government normally brings down the prices deliberately. And when it brings up the prices deliberately. And this motivates the suppliers to bring more goods into the market to cover the shortage in the market. Now, there is another reason why inflation may set in. We call it the cost push inflation. When the costs of production is too high, the government will set the prices low. Why? This will bring in, will make the prices to be low, and that encourages demand. When demand is encouraged, somehow the inflation that was caused by the cost push will be able to be solved. So, to solve inflation, the government may also impose price controls. Another reason is to enhance its revenue correction. The government will increase the prices if it requires maybe to correct more of money for its own use. Then also to stabilize the prices, the market, and also in case of minimum produce price floor, in case it wants to stabilize the market, it is going to create either a price floor or a price ceiling. That generally will help even the low-income earners in case of very high prices in the market. So, we look at the two kinds of price controls the government may set. It may set what we call the P-max or the P-min. Now, the P-max, which we also call the ceiling price, is the maximum price the product must be sold. It is normally below the equilibrium. Then we also have the P-min, the minimum price at which the product must be sold. It is normally above the equilibrium. Let's look at it through some curve here. We look at this, we have the demand curve and the supply curve. If the government feels that what has been set through the price mechanism, that is the forces of demand and supply, that brings the equilibrium price at EP here, what we are seeing, we realize if the government feels that this price, the equilibrium price, is too low, it may set the P-min, which is above the equilibrium. The P-min, or the floor price, it is that minimum price this product must be sold. And you notice that it is above the equilibrium. This is maybe to encourage the suppliers to bring more into the market. What is the situation when the prices are set at P-min? The demand, since the price is high, the demand will decrease and the supply will increase. Normally, this creates what we call excess supply, equivalent to Q1, Q3. Now, when there is excess supply in the market, there are a number of things that may happen. Number one, if the government wants to solve this and still maintain the high supply, the government will buy the excess and store as a reserve in their stores. So if the government does not do this, what is likely to happen is that there will be a lot of wastage in the market because so much has been brought into the market but nobody to buy. This discourages the suppliers, and in a free market, the price will automatically come back to the equilibrium. But where the government insists that the price must stay at the P-min, then it must be able to solve that issue. Otherwise, there will be a lot of wastage and the suppliers will be discouraged. Now, let's look at the other side of the coin, where the government puts the price at P-max. P-max, which is below the equilibrium price. What happens is that when the price is at this level, the suppliers, the demand will increase because the prices are low, and the supply will decrease. This creates a shortage in the market. What are the consequences of this? Now, normally, when there is P-max, there's a number of consequences. Number one, goods are likely to be sold in the black market because there is a shortage. And when the goods are sold in what we call the black market, we say the goods are being sold behind maybe closed doors or to a few friends, to relatives. They are not just put in the shelf for anybody to buy. Now, when this happens, it creates room for consumer exploitation. When there is a shortage in the market, there will be queuing for the goods. We see sometimes when there's shortage of petrol, for example, cars are queuing to get that product. When there is shortage in the market, there will be rationing. When you want to buy 2 packets of unga, you are told you can only buy 1. When you want to buy 3 packets of sugar, for example, you are told you can only buy 1. There is rationing in the market. Normally, when there is a shortage again, there is conflict. People will have conflict. People will be scrambling for the goods. All those are negative effects sometimes of the price control. Now, this can be solved when the government removes the price control and let the market, through what we call the price mechanism, to just control itself through the forces of demand and supply. But sometimes when the government still feels that it needs to have that price control, then sometimes it uses its own mechanism to buy off the excess from the market and meanwhile stabilize that market. That is the one way of solving it. Another way is to just let the market have its own way and forces of demand and supply to create the price, the stable market that we all desire. Now, I have come again to the end of that lesson. And before we leave, I have a few questions here, which you can do as review questions. I've asked you to define demand, explain the law of demand and the law of supply, the exemptions for the law of demand, distinguish between change in quantity demanded, that is the movement along the supply curve and demand curve, and similarly the shifts of both curves. Then I ask you to write short notes on abnormal demand curve, joint demand, composite demand, and finally the price control. I really want to appreciate you for listening to me. This was a long lesson, and I really want to appreciate. Stay safe. We need you everywhere. Thank you so much. That's the end of our lesson 2. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.